I'm Anish Teli, Managing Partner at QED Capital, and I'm going to talk to you today about core and satellite approach to portfolio building. After I talk to you about that, that will be followed by a Q&A session. So let's jump right in. This is just the disclaimer. So this is what we'll be covering today. We'll be covering asset allocation. We'll be covering the core and satellite approach to building a portfolio. We'll be covering factors, and then we will be covering how to use factors to create a core and satellite portfolio. A little bit about us. We started QED Capital in 2016. We mainly have quant-driven strategies and more system-driven strategies, which cater to the young mass affluent HNIs, etc. Our aim is to provide simple to understand, transparent products which are system-driven, which have low fee, and our interests are aligned with the client. Now, Ben Graham said that the first decision an investor must make when it comes to investing is about asset allocation. That is the most important decision that an investor makes, and I'm going to show you on the next slide why. These are the asset returns from gold, property, equities, and fixed deposits of bonds in India over a 15-year time frame. As you can see, post-tax, gold has given about 9% return, property has given about 10% return, but this is pre-maintenance. Equities have given 15% return, and fixed deposits have been in the range of 5%. Of course, this information is a little bit dated, but if you were to extend it to 2015, the order would not be different at all. Even though gold has done well in the recent past, over the long term, you will always see that equities will outperform property, real estate, gold, and bonds. That is why asset allocation is one of the most important decisions that an investor can make. And this has been backed by a study called Determinants of Portfolio Performance by Princeton, Hood, and B. Howard. This is a seminal study done in 1986, which concluded that asset allocation determined and accounted for 94% of the returns in a portfolio. Even David Swensen of Yale Endowment confirmed this, and that is why a lot of the endowment funds and pension funds in the US spend a lot of time on deciding where to allocate the money, in which asset class to allocate the money, rather than on picking managers or on picking securities or on trying to time the market. If asset allocation determines 94%, market timing and security selection account for only 6%. So obviously, where should you be putting your focus on? In the portfolio design and asset allocation together will lead to a superior long-term performance. Now let's talk about core and satellite. The core and satellite approach combines the best of passive and active fund management. And passive fund management basically seeks to invest in diversified index funds, which will deliver to you market returns at a low cost. And I'll talk about low cost as we go on. And the active approach is to seek outperformance over the market or over the index through trying to pick stocks or by trying to time the market. So the core and satellite approach is basically a framework to think about asset allocation in a more structured manner. So let's look at active first. What are the characteristics of an active approach? Active gives you the option to outperform, but it comes at a higher cost. There is the risk of manager. So if, for example, if the manager is on a hot streak and he's performing, and by the time you invest, and after that his streak starts of losing, then that you run that risk. The active approach also tends to focus a lot more on the shorter term, and it tends to be a less tax efficient compared to the passive approach because the portfolio churn is slightly higher there. Let's look at the index approach. or the passive approach. The index or the passive approach is guaranteed to deliver you market returns at a low cost. You have far more manager risk. In fact, I would say the only risk you have is whether your AMC will, how low the tracking error is, will your AMC give you. And that is the only risk that you carry in terms of the manager. The focus here is long term and it is far more tax efficient than the active approach. So if we combine these together in a framework, the core and the satellite, then the index approach should be at the core of your portfolio formation process and your thought process. And your actives should be the satellite around which your core strategy revolves. So by combining core and satellite, you get the best of both active and passive in your portfolio. What this also helps in is that it also takes care of the human desire to outperform and helps us to stick to a plan, because we all have this desire that we want to outperform the market. But over the longer run, we find that most of us do not outperform the market. But we would still like to allocate a certain portion, and this gives us a systematic way to sort of allocate a portion to that active part, which gives us an optionality to outperform. And at the same time, we do not touch the core of our portfolio, which is the index and the low cost one. And that continues to, we continue to stick to that over the longer run. Now, why are we talking so much about index fund? And let's talk a little bit about that. The index, the Indian mutual fund industry currently manages about 7 lakh crores total in active and passive. And currently we have around 1 to 1.5 lakh crores in index funds. Now the S&P index versus active reports, which have been covering India for a very long time, have shown that the odds of someone picking a consistent outperformer in the mutual fund selection that you have is very, very low. And this also is in line with our own study that we have done. And it shows that the odds of picking an outperforming mutual fund manager over the long run, who will outperform the benchmark consistently, the odds are worse than a coin toss. The odds are in the region of 30 to 40%, which are lower than a coin toss, which is a 50-50. So our findings are also, and these findings are also consistent with global experience that 2 out of 3 actively managed mutual funds underperform. And the biggest contributing factors to this are fees, the drift of, the style drift that the fund manager undertakes. For example, today large caps are outperforming, so the fund manager tries to chase that. Or if after 2 or 3 years, small and mid caps start performing, then fund managers try to, chase that performance. As you can see below also that, that over the last 5 years, even the rolling performance of large cap mutual funds as a category has fallen quite a bit, from 4.9% to about 0.2%. Some of the reasons for this in India is also that SEBI has introduced measures like earlier mutual fund managers used to benchmark themselves against a price return index, and now they have to measure themselves against a total return index, which means that includes dividends. So that makes it harder for them to outperform the benchmark. SEBI has also recategorized the universe for large cap funds. That means only the top 1 to 100 funds as per market cap, the companies as per market cap, can be bought by these large cap funds. So that earlier they used to allocate a larger portion of large cap funds even to mid cap. So that would give them a chance to outperform if mid caps tended to outperform. And the third reason is that that the fee that mutual funds charge, which is around 2%, makes it very hard for them to, the drag of that 2% makes it very hard for them to outperform benchmarks. And this has been, shown in studies consistently over the long run in India as well as overseas. The other reason is that, even by chance, if you happen to pick a fund which is performing well over the last, 4 or 5 years, the odds that it will continue to outperform over the horizon of your goal or the time horizon of your investment is very low. So if you see the graphic on the right hand side below, you'll see that the odds that a top performing fund remains in that quartile is around 36%. And then even from there, the odds that the top quartile fund remains in the top quartile even the next 5-year rolling 5-year period is again 35%. So if you take a probability of that, the odds that your mutual fund, which is outperforming currently, will continue to outperform over the next 10 years is around 9%, which is very, very low compared to the market, which you are guaranteed to get market returns through an index fund. Now, why index funds? And this is a story about what Ralph Wagner likes to talk about. And he says that he compares the market to the owner, and he says owner of a dog who's taking his dog along for a walk, but he's on a leash. That dog is on a leash. He cannot move very far away from the owner, but he tends to move around the owner a lot. He's very fidgety. Market prices are like that dog. If you keep your eye on the prices, chances are that you will tend to make a wrong decision. Whereas if you look at the owner, that are the earnings, the owner walks consistently in the same direction. His deviation from the path is not very high. So it's better to look at the owner. It's better to bet on the underlying earnings, and earnings and prices over the long term tend to converge. So it's better to focus on the earnings. It's better to focus on the long-term performance of the index. And as you will see in the next graphic, that the earnings of the Sensex over the last 25 years have grown at around 9.2% before fees, and the underlying earnings per share of the Sensex has also grown at around 9%. However, you look at the standard deviation of the prices of the Sensex, that is at around 30%, and the earnings per share have a standard deviation of only 14%, which is less than half of that of the Sensex, which means earnings are far less volatile and more predictable, therefore, than prices. So index funds, which basically track a popular index, a broad-based index like a Nifty 50 or a Sensex 30, will tend to do as well as the underlying companies of that portfolio, and this will be available to you at a very low cost, which is today index funds are available in India at a cost of 5 to 6 basis points. So that's very, very low compared to 1 to 2. Even in a direct large cap fund or a direct mid cap fund, you tend to pay around 1.5%, which is fairly high. So here's the cost that I've been talking about. That every year around 15,000 crores is paid by the investor to mutual fund distributors and advisors as commission. That's 15,000 crores every year. And India is one of the highest cost mutual fund market globally. Even though SEBI has now made a lot of changes, we still tend to remain very, very high. And the table below shows that, especially in the short run, you will not see a big gap between your returns from the active mutual fund and the index fund. And you think, if my mutual fund is outperforming by 2 or 3%, then it's okay if I pay 1% extra to the mutual fund manager. But when you look at that cost over a 10, 15, 20-year period, you will see that it reduces your corpus by almost 25 to 30%. And if you go beyond 25 years, it impacts your corpus by more than 50%. So that's the impact that fee has on your corpus, and which is why you must be very, very conscious while choosing an active fund manager for the long run. That is he going to stick and is he going to consistently outperform the index? Only then it is worth paying that 1.5-2% extra to the mutual fund active manager. Now, how do we execute a core and satellite approach? We talked about an index core and an active satellite portion of the portfolio. So the core will always consist of index which is low cost, which is a well diversified portfolio, and it usually tracks a market benchmark, a popular market benchmark like a Nifty 50 or a Sensex in India or S&P 500 in the US or the Nasdaq in the US. The allocation between core and satellite is done after taking into account your risk profile, your investment goal, the time horizon for which you're looking to invest, your age, your income, your codependence, any other liabilities that you may have over your in your current stage, and then it is determined how much risk you can take, and then you can decide on an allocation between how much are you going to allocate to your index core and how much are you going to allocate to your active core. The longer your time horizon typically and the higher your ability to take risk, the more you can take risk in the active part, and the lower your risk appetite and the lower your risk ability, the more careful you need to be and the more defensive you need to get in your allocation. So you will have to allocate more to the defensive assets, and the less risk you will have to take in your portfolio. Now, what you have to do also as part of this execution is that as you approach your goal, you have to cut down on the risk in your portfolio. So let's say you started with an 80% allocation, let's say to equity and 20% to bonds. As you can see on the graph below on the left-hand side, as the closer you move to your goal, you have to reduce the equity weightage in your portfolio, so that if you run into an event like we ran into in March, or you run into a 2008 event, or you run into some even a fluctuation like a flash crash that we ran into in 2010, and you need the money 6 months down the line, but the market has not recovered, then at least your money is safe to that extent. So basically, you have to take your portfolio on a glide path approach, and as you start approaching your goal, you need to cut down risk, but you still need to maintain. Let's say if you started with a 70-30 allocation to equities and bonds, or as you reach your goal, you will have to switch that allocation, and 30% will be perhaps your equities and 70% will be your bonds. You have to cut down that risk, but you still need to keep a certain amount allocated to risk still, because you still have to enable that a certain portion of your portfolio grows to outdo inflation over the long run. Now let's look at a couple of examples in terms of how would we construct a core and satellite portfolio. Let's take the first example of somebody who wants to build a retirement fund and has a 15-year horizon to do so. In that case, you would allocate around 45% to an index equity portfolio. You would perhaps allocate 25% to bonds and 5% to gold, and that would be your core portfolio. Your satellite portfolio would have around 25% to active equity. This is designed for growth over a 15-year horizon. And also, please remember this is only a suggestion. This is not something to be replicated, because every person will also have a different risk appetite and also different income streams, and his life situations are different. So this is only a typical allocation that I'm showing here. And this is designed for growth over the longer run with periodic rebalancing along the glide path, as I showed you along on the previous slide. Now let's look at another goal where somebody says, look, I am already set for retirement, but I do want to build wealth, to build optionality, and I may want to do philanthropy after 20 years, or I may want to pass on some wealth to my next generation and save money for that. And in that case, since your goal as well as your horizon is slightly longer, you would be more aggressive, and we would allocate perhaps 35% to an active portfolio, 45% to the index, and only 15% to bonds. However, even here, we would tend to rebalance over every 5 years and every 10 years to reduce the equity risk in the portfolio. And as you move closer to your goal over the longer run, we will, cut down equity and start allocating more and more to the fixed income or the bond side of the portfolio. So basically, when you are deciding how much to allocate to your core and your satellite portfolio, you need to determine what your goal is. You need to determine what your investment horizon is. You need to look at your tax situation. You need to look at how much risk ability you have and how much risk tolerance you have. Some people have the risk ability, but they are not able to tolerate the amount of volatility that sometimes comes along with equity investments. And very important, once you implement the plan, you have to review this only on an annual basis. Please don't, keep on checking every week or every month. Maybe once in 6 months is a good idea to sort of, look at your portfolio and do a detailed review every year with your financial advisor. And more importantly, if nothing has changed, don't change the plan, just stay the course. Now, let's come to the second part of our topic today. We've covered the core and satellite approach to investing. Now, let's look at how we can use the factor-based approach to investing and look at that through a core and satellite framework approach. So, what are factors? Let's look at that first, and let's look at how factors come about. So, markets are driven not just by the information that and performance of companies in the short run and the long run, but they're also driven by human beings and the collective behavior of human beings over the long run. And there are certain biases or certain behavior patterns that people tend to repeat over and over again. And some of these are, the lottery effect, that is the tendency to buy stocks which have a lottery kind of payoff, something like a Yes Bank or something like a Vodafone or something like a Suzlon, which will look very cheap compared to the past. And that's where the anchoring bias comes in. You've looked at Yes Bank at 400 and at 50 rupees, you think it's very cheap. But 50 rupees can go down another 50%, and from there it can go down another 50% before recovering. But people tend to think that, if I buy Yes Bank at 50 rupees, it may go back to 100 or 150 or 200. How much lower can it go? Trust me, it can go a lot lower than you can think. We also investors also tend to have a confirmation bias. They tend to make up their minds before and then look for information which confirms with their decision, and that creates a big problem when it comes to investing. As well as the disposition effect, which we see a lot in markets. That is, investors tend to hold on to their losers much longer, and they try to sell their winners very fast. They don't hold on to their winners, and I'll show you that on a slide later. But that comes from the human brain's ability to not bear pain, because by selling a loss-making stock, you are admitting to yourself that you made a mistake, and by holding on to a winner, you are scared you will lose out on profits. Like, what if the price comes down? But you have to do exactly the opposite. If a stock is going down and you need to have a plan for that, beyond a certain percentage, you need to sell that and reevaluate. Whereas if a stock is doing well, or if a fund is doing well, or an index fund, or your portfolio is doing well, you need to stick to the plan. You need to stick to that stock, and you need to hold on to it. But as new investors tend to come into the market, and even old investors, as a group, we tend to repeat our mistakes over and over again. And that creates, these kinds of pricing inefficiencies. And that also creates a behavior gap between what investors can achieve and what they actually achieve. So let me show you on the next slide, an interesting graphic which shows the valuation scale. And the market remains in a low valuation or a attractive valuation zone about 30% of the time. it remains in an overvalued zone around 39% of the time, and it remains in a fairly valued zone around 30% of the time. However, investors tend to put 75% of the money when the market is overvalued, and only 2% of the money comes in when the market is undervalued. So that tells you, how much we are not able to implement buy low and sell high. Instead, we do exactly the opposite. We sell high. We try to buy high, and we sell low, because if you see the bar chart on the right hand side, this is a study that is done every year in the US, and it is also done in India, which shows that even if the average stock return or the stock market returned around 9% for the year, the average investor lost around half of that, or at least 4%, due to these timing errors. They try to time the market, and invariably they end up putting money into the market when the market is overvalued, and they tend to put less money in the market, or they tend to pull out when the market is undervalued. So that creates that behavior gap, and to bridge that behavior gap, you need to have a process, and you need to execute that plan in real time. And that's also a thing that investors find it very, very difficult to do over the long run. Now, just as an example, look at this. Look at this graphic, which shows you which HDFC put out for their balanced fund. Over a 10-year period, only 3% of investors held on to their investment, and that is in a balanced mutual fund. Only 23% of investors held on to an investment for over 5 years, and only 50% of investors held on to that investment for over 3 years. So while everybody comes into the market saying that they are an investor for the long run, the behavior and the data certainly does not seem to confirm that fact. Investors do not hold on, and that's a more behavioral issue rather than an analytical issue, and that's what creates inefficiencies and lower returns for investors in the long run. And that is why, again, we look at the approach of core and satellite, that if you have a core and satellite portfolio construction, whatever is there in your core portfolio, you do not tamper with that, you do not touch that over the long run unless something has changed dramatically. And do not touch your core portfolio over the long run. Hold on to it, but and allocate a smaller portion to your active portfolio, and that is the portfolio that you can experiment with or try to use that to outperform over the longer run. So what is a factor? The factor approach actually came in through the study of psychology, where they were trying to predict human behavior, and they tried to classify people in groups through their education background. So let's say you were looking for a certain buyer of a certain car, and then they would try to profile that group of people who were buying. So would it be a male over a certain age with a certain education in a certain socio-economic category, having an income over a certain percentage. And then they would try and predict customer behavior using those factors. And that same thinking was applied to markets. And they said, and academics looked at that, and even practitioners, as I will show you later, looked at that and said, could we look at stocks that behave in a certain manner? And can we pick stocks which show certain characteristics? And what are those characteristics that tend to persist? Because if those characteristics are temporary, then you cannot build a portfolio which will perform uniformly over your long-term horizon. Those characteristics have to be common across a broad set of securities, as well as they have to be consistent and persistent over the long run. So one important factor is the equity market factor, or the broad, the impact, that the effect that investing in equity as an asset class tends to outperform fixed income over the long run. Why is that? Because equity is a more riskier asset than fixed deposit, and you are getting compensated for taking that risk. So if you are investing in a fixed deposit or in a bond, your investment will tend to move linearly and incrementally slowly every day, little by little. However, when you invest in equity, there is a lot more volatility. There is a lot more risk that your investment may be, down by 15, 20%, even 30% at times. You may not, you may see lumpy returns. For example, it may be down for 2 years, and in the third year, you may get like a 30, 40% return all together. So equity returns tend to be lumpy, equity returns tend to be risky, and equity prices tend to be more volatile. So you get a premium for investing in equity as a whole. And when we say as a whole, we tend to talk about the market. And a way to sort of implement this factor, as we will see later, is by buying an index fund, which sort of represents the majority of the market. The other characteristic that, or other factor that has been, has proven to do pretty well over the long run, both globally as well as in India, is momentum. That a stock that or an asset class that has done historically well in the past over a certain period, and that period has been found to be between 6 to 9 months. So if you see a stock or equity or gold or some other asset class has done well over a 6 to 12-month period in the past, it will continue to do well in the future also. And that happens until the trend changes. But this momentum tends to persist, and that persistence is, you can sort of capture that if you have a process to do that, and if you have a system to implement that kind of a process. The third factor that we can look at is low volatility. That low volatility stocks tend to outperform high volatility stocks. The other one is value. That is, cheap companies tend to outperform. When I say cheap companies, I mean a portfolio of cheap companies tend to outperform a portfolio of expensive companies, again, over the longer run. And so on and so forth, size, quality, and you can look at that. Why do these factors work? I spoke about risk premium, and I showed you the systemic behavioral errors that human beings tend to make in the market. So they create inefficiencies. And that is why if you use these factors in a portfolio, you will be able to benefit and profit from that. Let's look at evidence from global and Indian markets that are we really able to capture any premium from there. So here you can see from the market factor, you get a mean return of around 8%, but the standard deviation is also very, very high. From the momentum factor, you get around 9% with an even lower standard deviation or risk than the market factor. Now let's look at India. And we tend to see a similar pattern in India, where the market gives you a return of around 4% over a risk-free rate of interest, whereas momentum gives you approximately 19% over the long run, with far less volatility. And this study has been done by IIM Ahmedabad, by finance professors at IIM Ahmedabad, and they update this data every month. And we have the data updated up to December 2019. So if everything is so simple and it's known to everybody, and it's able to, it's out there, academics have proven it. Why is it that people are not able to benefit, or they are not able to create wealth using this knowledge over the long run? And that is the same reason why why people know everything about dieting, people know everything about fitness, but they do not exercise, or they do not follow a good healthy diet over the long run. And that is why, in spite of having the knowledge, in spite of having the awareness of what to do, human beings are typically unable to follow that over the longer run. So, this is a famous anecdote that Jeff Bezos looks at Warren Buffett and says, you're the second richest guy in the world. and everybody knows your investment thesis, and you've been telling people over the long run how you buy and how you sell, and even your investments are known to the world. So why isn't everybody just copying you? Why aren't they doing that? And Warren Buffett just looked at him and said, because nobody wants to get rich slow. And Warren Buffett is a living example of that, because around 80 to 90% of his wealth was accumulated after his 60th or 65th birth year. So, that's how patient he was willing to be. He read the reports of IBM for around 50 years before buying that stock, and still made a mistake. But as soon as he realized he made a mistake, he sold his stock and got out. He did not stick to his mistake. So let's look at how Warren Buffett used factors. And yeah, that's me surprising that I also came across. But Warren Buffett implemented factors in his own way, and he discovered quant factors long before academics did, and long before other investors did. And that was his genius, not the fact that he was a great stock picker, not that he isn't, but this is an aspect that not many focus on. So in 2013, AQR wrote a paper called Buffett's Alpha, and they looked at the sources of Warren Buffett's returns over the years. And they came to the conclusion that his returns were neither luck nor magic, but he bought cheap, safe, and quality stocks over the long run. And he ran an insurance company. So an insurance company always has a float, or the insurance premiums that are collected upfront, and the insurance is paid out. The insurance claims are paid out over the longer run. So you have a lot of float to sort of invest over the long run. So he took that float and he bought a lot of cheap, safe, and quality stocks. And so basically he was leveraging his portfolio at 1.6 times, and that's where a lot of his outperformance can be understood and explained. So not that he was not a great stock picker, but if he had bought any other stock other than Coke, other than Wells Fargo, other than American Express, which had the same characteristics, his returns would not be very different. So he started off with value, but over a period of time, as he realized that he had to add safety and quality, because he was also leveraging his portfolio and his size was growing, he decided to add safety and quality as a factor to his portfolio and to his stock picking. And he has stuck to that for almost, he did this in 85 to 90. So it's been almost 30 to 35 years since which he has been continuing to do this. Even though he missed out on Amazon and Apple in the early days, he's added Apple around 5 years ago and sitting on it's one of his largest investments, and it comprises of almost 45% of his investment portfolio today. So how do we implement, factor investing, and why are we looking at factor investing? Because it sort of gives you the best of both worlds in terms of passive and active investing. It can be done in a systematic manner at a lower fee. It gives you the potential for outperformance. It eliminates the bias and emotion that we spoke about earlier, and it is the turnover is far, far lower than active investing. So that sort of combines the best of passive and active investing, and it is and the lower fee is also a very good attraction. The manager risk is also low, because the factors are known to you upfront. What is the criteria that is going to be used to build a portfolio? Whether the manager is sticking to his to the rules and to his investment thesis over the long run can also be measured in a factor portfolio. So that becomes much easier to make a decision whether to stick to that factor investor or not. So, that's why we are looking at factor investing in the context of core and satellite approach to portfolio construction. Now let's look at how we can practically use factors to create core and satellite portfolios. The first factor that I spoke about was the market factor, or the factor of the owning the market as a whole, and that usually is your core that you would use that as your core, or at the middle of as the center of your investing portfolio. Now, using an index fund and a short-term debt fund, you can create a passive core portfolio. Now, usually a balanced portfolio, we are familiar with balanced funds. They have a equity component, they have a debt component, and sometimes they have a short-term money market component. The weights are fixed. Usually, we've heard of 60-40, but sometimes they are aggressive balanced funds, so they can be in the range of 70 to 90%. Or if they are less aggressive, they can be in the lower than 60%, and sometimes we have 50-50 or 40-60. But you can create those weights. Those weights are known upfront, and periodically, as the weights moves. For example, if you started off with a 60-40 allocation to equity and 40% to debt, let's say you had a year in which you had a very good year, and your weights of your portfolio moved from 60% to 70% equity and 30% debt. Then the way you would rebalance in your in the first year is that you would sell 10% of your equity portfolio and allocate it to debt. On the vice versa, on the flip side, if you had a bad year and your debt allocation went up from 40 to 45% and your equity allocation fell from 60 to 55%, then you would sell 5% of your debt portfolio and allocate to your equity portfolio. So basically, you will buy low and sell high. That gives you a systematic and a proper way to implement your plan and not be caught up in the heat of the moment and saying, oh, what do I do now that the market has fallen and my weights have fallen, and how do I rebalance? You have the plan up front. You have discussed it with your advisor, and that's how you can implement your plan. And balanced funds are typically ideal for investors who are coming in and getting exposure to the equity market for the first time, as well as those who are a little bit risk averse but want to get equity exposure over the longer run at a less volatile but want a less volatile journey along the way. So let's look at how a balanced fund using an index fund for equity exposure and a short-term debt fund for debt exposure. How do the returns and how does the volatility work out over the long run? So we looked at returns from 1990 to 2020. That's around 30 years. And if you had just bought the index and the index in 1990, you would have got a return of around 12%, and you would have seen standard deviation of 27%, which is fairly high. If you had started a 60-40 portfolio in 1990 but had not rebalanced it, you would still have got around 11% returns. But even then, your volatility would have come down quite a bit. But look at the column on the third side where you rebalance your portfolio, and you harvest almost all of the returns that you would have got from a 60-40 portfolio at a far lower risk and at a far lower drawdown. Of course, you have to take into account your tax situation. You have to take into account whether you are able to implement this this construct or not. But if this shows you that even though you sacrifice around 2% returns over the long run, you are able to cut down on your risk by almost by almost 70 to 80%, and that in itself will enable you to stick to your allocation over the long run. So this is how you would create a core passive portfolio if you were looking to create one. Some people also, this is just an example. You can add gold to this if you want to. That also has a good hedge, but around 5 to 10% of gold would also not be a bad idea for those who want to own gold also as a hedge against inflation. So that's because in the recent past we've seen gold also do well, but as I've shown you in the graphic earlier, over the longer run it is equity that will outperform gold, but it's still not a bad hedge to have against inflation. Now let's look at factors and see how you would use that to create a satellite or an active portfolio. And I'm just taking two factors here. We use them to create our active portfolio solutions. So how you would implement that is you would start with an investment universe and look at all the listed companies that are listed on the NSE or the BSE. So the way we look at it, we take the top ranked companies because they also tend to have higher liquidity and they also tend to be more liquid and have more shareholding. And then we take the top 400, we cut down that universe and we screen them on momentum and volatility, and we look sort of bring it down to 80 to 100 stocks, and then we again look at the third part of portfolio construction, where we sort of rank the stocks, do a check for quality, do position sizing based on risk, and then execute the process. And then we keep on rebalancing this at a predetermined frequency to ensure that we keep the winner stocks and we exit from the loser stocks. So basically, this is how we implemented. We use alphabets, which is a rule-based factor portfolio. We use momentum, low volatility, and quality. We periodically rebalance the portfolio. And index alpha is where we use a balanced portfolio, where we use index and debt ETFs, and we periodically rebalance them to manage risk. And you can combine them, to make your core and satellite portfolio. So, that sort of brings me to the end of my presentation. And, if there are certain books you want to refer to, we've written a lot of blogs on this. So you can go to our website and you can see that on the screen. These are the two books I would recommend you to read if you want to learn more about index funds and factor investing. And with that, we'll move on to Q&A. And these are our social media handles and our emails if you want to get in touch with us. So, now we'll move on to the Q&A session, and let's look at some of the questions that have the lot of questions that have come up. So let's look at Rahul has said, what is an index fund, and so in index fund, Rahul is basically a fund which is based on a benchmark like a Nifty 50 or Sensex 30 or the Nifty Next 50. And it tracks the index. So basically, it comprises of those stocks in exactly the same proportion and in the same weightage as it is there in the index. So, for example, today the Nifty 50 comprises of Reliance of 13%, has HDFC Twins at around 8-9%, has TCS, Infosys. So, in the exact same ratio that the Nifty holds these stocks, the index fund will also hold these stocks. There will be no fund manager decision saying that, okay, I want to underweight Reliance or I want to overweight something else. The fund manager has no discretion on that. They will simply mimic the weightages and the names of the companies that are there in the underlying index. So, that is an index fund. And that because of that, it's available at a very, very cheap or a low cost. And most active mutual funds, like I showed you, are not able to outperform the index. So Rajiv asks, what is the ideal investment proportion in core and satellite approach? So I spoke about that also. I showed an example. So Rajiv, that depends on your goal, and that depends on your investment and your investment horizon. Your risk appetite, your risk ability, how much are you able to save, how much are you able to invest, and so it really depends a lot on that. but ideally you can use the core and satellite approach to sort of think about and use this as a framework to plan your allocation. So I showed you that if your investment horizon is 20, 25 years down the line, you can be more aggressive and allocate more to equity and less to debt. But if your investment horizon is lower and it's it's a critical goal that you have to meet, then you have no choice but to be more defensive, allocate more to debt, uh, more less to equity, and you have to save more. There's no going around that. Mohammed Akil asks, so Mohammed asks, investment in index funds is quite popular in the US. Is it really beneficial to invest in index funds in India? So Mohammed, we've done that study internally at QED Capital also. S&P also is an independent provider, or it brings out these independent studies very regularly. They have looked at longer periods. They've looked at 5 years, 10 years, 15 years. They've looked at a lot of mutual funds, and they also come to the same conclusion that yes, it is more beneficial to invest in index funds. And in India, at least, the large cap, it is nowadays, even most advisors, distributors will also tell you that there is very little alpha that you will get in a large cap fund. Even I would say, dare to say, even in a mid cap, it is going to be very, very hard to outperform the benchmark. So if you're not really a hands-on investor, if you're not willing to do the hard work, and or if you're not a full-time investor and you're looking to get market returns, trust me, if you invest your core portfolio in index fund, you will do far better than 60-70% of the market, definitely over the longer run. And a couple of other questions around what should be the time horizon to hold. Vinay asks that how many months or years should one hold on to. So Vinay, I would, like I said again, you have to look at your goals. You have to align yourself to a goal. Only then will you be able to take a decision, because it cannot be open-ended. Or if you have an open-ended goal, so that you are investing because you want to build a corpus which will give you options in the long run to sort of, if you are working, you may want to retire early, or you may want to start your own business. So after 15, 20 years of working and you want to build a corpus for that, then you can target that as your time horizon, and you can target that as your, or if you want to build a very large corpus, which you want to, use for philanthropy, or you want to pass it on to the next generation for their safety, or you want to build you want to buy a house after you retire, then that can be your goal, and that's how many years or months that you will have to typically tend to hold on to your investment. And that's how also you'll have to look at the glide path, like I mentioned, that as you move closer to your investment, or as you move closer to your the date of your your goal, you'll have to cut down on the equity exposure, and you will have to sort of make it more fixed income or debt heavy and less of equity risk exposure. So Anjani asks how to diversify for a person who's in early 20s and wants to invest for the long run. Anjani, like I said, somebody who is, like I said, is starting off and he wants to learn about equity investing, and he wants to talk about, he wants to, learn about the stock market. I think the balanced fund is the best way to start off with, and the balanced fund is the best to start off with, and that gives you the flexibility of the exposure of investing in equity, as well as it reduces the volatility that you may not have experienced as an equity investor. And as you go through an equity cycle, you will also learn more about yourself. You will learn about how much risk are you able to take, how much risk you are able to tolerate in your investment, and that will be very important learnings for you as you go along, and that will answer a lot of the questions that you have for yourself, or at least you will know what questions are relevant to ask to your advisor when you are making your financial plan for your future goals. G2 asks, how to decide what investments are good for core and what are good for satellite. So G2, what are investments that are good for core? Like I said, typically passive investments that we call. Now, nothing is really passive, but we want to categorize things into either this bucket or that. So most index-based funds are called passive investments. So let's say currently you have index funds based on the Nifty, you have index funds on Nifty Next 50, you have a mid-cap ETF fund. Those would be typically investments that you would, qualify, that would tend to qualify for your core portfolio, and that would be good investments to look at. And for the equity part of your core portfolio, for the debt part of your core portfolio, you can look at short-term bonds, short-term liquid funds. You can also look at some of the shorter duration ETFs that are now listed, and if they have liquidity, then it's very important to check liquidity in an ETF. So some of those ETFs could also be used in your core portfolio. And for your active, or your satellite part of your portfolio, you should consider factor funds that are available in mutual fund, as well as you can look at there are factor ETFs that are also available. You can look at some small cases that are available. So there are many options available for your active, but you have to look at your goal. You have to look at the risk reward that theme offers, or the particular active fund offers, and does that fit in with your investment goal and horizon or not. Rebalancing, there are many ways to do rebalancing. One is to either look at the weights. So that's Ritika asked that question about rebalancing. And Ritika, rebalancing should be looked at in the context of your tax situation. Should be looked at in the context of how much risk you can bear, and in the context of how far along the way are you to meet your goal. So if you take all those into account, you should typically do an annual review, and then take a call whether you need to rebalance, whether you need to cut down risk, whether you need to add more risk to meet your goal. So anything less than a year, I think, would not be adequate to keep on looking at and try to rebalance. Your active part, on the other hand, where you allocate a smaller portion, that you can look at perhaps on a 6 monthly or a yearly basis, and see whether it is meeting your goals or not, and then take a call whether you want to add more active risk, or you want to again rebalance and take, if your active portion is not performing and your passive portion is outperforming, you may want to allocate, and you're more comfortable with that, you may want to rebalance your active and your satellite exposure also. So, I think we've answered most of the questions that have been asked. And, the whole, just as we end, I'd just like to summarize that, with what we started with, that asset allocation is one of the most important decisions that you will take. When I say asset allocation, it is how much you will allocate to equity, how much you allocate to gold and other commodities, how much do you allocate to real estate, and how much do you allocate to fixed deposits, bonds, and other fixed income kind of assets in your portfolio. That is the most important part. That accounts for a large portion of your returns in your portfolio, and that's where you should pay most attention to. Market timing, trying to buy the best stock, or buy the most outperforming stock. As humans, we tend to want to get onto that, and we want to have that in our portfolio. So you can allocate a certain portion of your portfolio to that, maybe to begin with. But you should try and have the core of your portfolio there. That's where you should get your asset allocation right, and that is what will be the driver of your returns in the future, and that will enable whether you are able to meet your goals. Remember, everybody, this is personal finance. It's personal to you. Your goal, my goal, you may not be the same as your neighbor's goal, or as your colleague's goal, or somebody else's goal. So look at your goal, determine your own risk appetite, and then find products that fit your own risk appetite and investment horizon. And the core and satellite approach is a very good approach, and a very unique approach that is used globally as well as in India to think about this very important issue about asset allocation. So, with that, I'll come to the end of this session. And if you have any questions, you can reach me on Twitter. I'm very active there. Or you can email us. You can go to our website at qedcap.com. You can go to indexalpha.in. There are many blogs there. You can subscribe to our newsletter, and you can look at our small cases on the small case microsite. So thank you all very much for coming. I hope this was useful, and I hope to do this again sometime. Thank you, Small Case, for hosting me.